Hey, everybody, we're back. Hey, before we get started, Paul and I want to bring to your attention a live Wealth Warehouse webinar we're going to host on February 13th at 4:30 p.m. Central Time. So do your Valentine's Day flower shopping, chocolate shopping before that. Come to the webinar and bring your questions. Whatever you guys want to talk about, we'll do it. We'll do it for an hour, and then we'll probably start doing these more consistently. What do you think, Paul?
Yeah, I think it's great. And I would also add, invite your friends you've been talking to, business owners you've been talking to, either actively or passively about the infinite banking concept. Bring them as well. Invite them as well. Feel free to forward that to anybody that you think this might resonate with.
Absolutely. All right, everybody, for this episode, Paul and I are going to dive into part one of our I guess, dissection of page 85 in Nelson's book, Becoming Your Own Banker. So if you got your book handy, get to page 85. We'll be talking through half of those points now and then half of those points next week in part two. So it was fun. Hope you guys enjoy. Hey, I'm Dave.
And I'm Paul.
And this is the Wealth Warehouse Podcast. Paul, what's going on, my man? You got some big news this week, right?
Yeah, I did. I got my DD214 yesterday, which took some effort. I was told to be there at 10 o'clock. I was there at 9:50. I think I got my DD214 at, I don't know, 13:45, 1400, because they weren't ready, and then they had to go to lunch. They don't work during lunch, and then it was just
close for training.
Yeah. So there'll be some ice comments, but the lady that helped me was great.
The DD214, for those who don't know, is what you get when you're leaving the military, and it's your proof that you served. You were a veteran.
That's right.
So that's that's gold.
Yeah, and they give you multiple copies. There's copy 1, copy 4, and copy 7. Don't ask me where copies like 2, 3, and 5 and 6 are. I think that's just the nomenclature of them, and they all have different kind of the same information, but different as well. So it's kind of weird. So it seems like copy 4 is the one you'll send for jobs or for most things. So anyway, hopefully that helps somebody.
Keep it handy. Yeah. All right, man. Well, congrats.
Thanks.
Very cool. Very cool. So you and I were talking yesterday. You had an interesting conversation with somebody at Anthony's basketball game, right?
Yeah. One of the I don't want to get it too personal. The information was shared with me, but basically, this guy I was talking to had no idea what I do with IBC or in finance or whatever. He was just asking me, "Hey, you're retiring from the Army soon?" Yeah, and gonna do, what are you going to be doing? I'm be in the financial space, and I didn't tell him, whole life insurance quite yet. And then he's like, yeah, we have a guy, but I'll tell you what, the one thing that I wish I had done is bought whole life insurance. And I was like, oh, it's funny you mentioned that. That's exactly all I do. Like literally all I do is teach people how to, use strategic whole life insurance, specially designed contracts to do something called the infinite banking concept. Anyways, oh, cool. And I was like, yeah, let's get together, whatever. And he's like, well, the thing is, I've had just a slew of some, health issues that just popped up in the last 6 to 12 months, and kind of went through, long story short, he's uninsurable right now.
So is that why he wished he would have got whole life insurance, or is it for the banking aspect?
We didn't get that far. We were just kind of walking out. I plan on having a future conversation, so I'll probably have a follow up maybe to what we talk about here. I'll follow up with him, but I think most people. I think it depends. I would say that he probably doesn't know how to use whole life insurance strategically like we do, but I can tell he would be. He's a super nice guy, and just I know he would be into it for sure.
Yeah.
But I think he just wishes he had that protection in place as far as the death benefit, just in case now, because people start thinking like, oh crap, like I don't have as much, my nest egg's not as big, or whatever. I have nothing is liquid if it's in a form, whatever it is, whatever the case. They just, again, folks, this is another example that Dave and I have come across where the conventional advice that you're being slung out there on Dave Ramsey show or whoever is dangerous information, and it has now burned many people that I know.
Yeah, it's not just bad information, it's dangerous, like you said. Because how many people, yeah, anybody who's got a W-2, most often they've got group term insurance. So, they feel like, I don't need life insurance, I've got this. Well, when they leave that job or they retire, most people probably still have a need for life insurance.
Absolutely.
Or at least still wish, man, it would be nice to have more money coming to my family when I pass, when I graduate here.
Yeah, in fact, one of my most recent clients here in Virginia, young kid, very talented, very intelligent. All he had was group policies through his employer. Mm-hmm. And we talked. I was like, those go away if you change jobs. That coverage, it was significant coverage. It was over $1 million total. It was several policies that he had through his. Those go away. You don't own that policy.
He didn't
just
realize
like
that?
SGLI. I don't know if he really realized that. Huh. A lot of people don't, like SGLI, as an example for military. Like, that goes away. Now you have VGLI and all that stuff, but that's a terrible, unless you're uninsurable, that's a terrible way to go.
Yeah.
So, anyway.
Yep. So, well, that'll kind of go into one of the things we're going to talk about, regarding, don't wait for Uncle Sam to rescue you. If you think, think Uncle Sam, when you leave the military, is going to keep providing you that free, quote, free life insurance. Think again. I guess it's not free. You still even pay for it out of your paycheck.
Yeah, it's like $29 a month or something.
Yeah, it's very cheap, but it ain't going to last.
Right.
So, all right. Well, speaking of, we thought we wanted to cover a single page in Nelson's book. So if anybody is sitting down while they're listening, grab your copy of Becoming Your Own Banker, 5th edition. And, Paul, I think this is the way people should read this book. They should start with page 85.
Yeah.
And then go back to the beginning and read the book through, because 85 is such a great bullet point list of the reasons why you might want to do this. And if you start here, it's like reading the Cliff Notes of a book before you go read the full book. It actually helps you retain and connect dots a lot better.
I think so too, and I'm glad that our Canadian friend kind of pointed that out to us. I think I used to start with page 3 because that's the first page, which also has a ton of good information and a way to think about things as well. But this is a nice consolidated kind of one page of text that kind of gives you the rundown of what Nelson's actually talking about. And moreover, I would say throughout the book, though, he provides a summary on each section as well. So those are good places to go back to, right? Like points, this is points to consider, but there's always a, section whatever summary at the end of the certain sections of the book, which are also helpful to kind of recap what you just read.
Yep. Absolutely. So what we're going to do, we're going to read this verbatim, and then we'll talk about every single point here. There's like 7 bullet points. So I'll start, and then we'll just talk about this. But if if you've only read page 85 once, read it again, then read it again, then read it again. In fact, I had a client email me this morning, or he's about to be a client, but he's like, I kind of haven't had that light bulb moment yet. Can you remind me again why, what the best reasons for doing this are? I'm going to tell him, I'm going to respond to him and say, read page 85, and then go read pages, 3 through 3, 4. Yeah, 3 and 4. Pages 3 and 4.
3 and 4.
85 and 3 and 4. If you do that, you've roughly got the concept. You just don't have a full understanding, but you've got the overview of the concept right there.
Yeah. And like we talked about on a recent episode, Dave, most people are too into the weeds and suffering from what you call the analysis paralysis. They're just they're focusing on the wrong things, whether it's numbers on a page or something else. And I think you're right that, page 85 really gets to like, hey, this is what it's about. Okay, I
Gets
got
to
it.
the point.
Yeah.
Yeah. All right, so let's start with point number one. I'll read through it entirely and then we'll talk about it. So there are only two sources of income: people at work and money at work. In the typical American family, through the first half of the 20th century, the father worked outside the home and the mother managed the home, nurturing the family and instilling spiritual values as the children matured. Now it is widely accepted that a family can't make it without both spouses working outside the home. It takes two incomes just to make ends meet. Could it be a fact that this modern family has no money at work? So, what do you think about that,
That's
Paul?
exactly the case for most families.
Right. One source of income is at work, the human, the person.
That's right. I have a good client. You know who he is. His name's Brent. I'll give him a shout out here. He's an engineer, very smart, very successful guy, and he's always talking about billable hours because he's a business owner and he is the business, right? And he's got employees, but he is the engineer, right? And now that he's linked up with this community of infinite banking and he's part of the other community, right, that you're helping build, is not having to trade billable hours for money. That's what he's after now. So
Yeah.
taking that kind of growth mindset of socking money away in a 401k or some other qualified plan, now shifting to more cash flow investing, building capital across his whole life policies. So that mindset switch, so that when he is older, 20 years from now, when he's 60 something years old, he doesn't have to trade billable hours for money. He's created these systems that pay him while he's sleeping, as our friend Warren Buffett has said.
Yeah, Warren Buffett says if you don't learn how to make money while you sleep, you'll be working for the rest of your life. And that's what most people do. Even in retirement. I mean, how many people do you know that are your parents' age that are still working? Not
There's a
because
whole
they want
bunch.
to. Not because they want to.
Right. Oh, no, because they have to.
Yeah.
In a lot of cases, very if they had a pension, they were lucky, because most private company pensions are deceased,
Yeah.
in favor of the 401k.
They've graduated.
Yeah, exactly. They have graduated, and for good reason. And Buffett wrote about those years ago. I think it's the pension idea, like a little letter he wrote or a pamphlet he wrote back in the 70s, I think, pointing out the terrible idea.
Mm-hmm.
Am I getting? Was that Buffett, or is that Paul Perot? I'm confusing them now, maybe. But
Well,
who wrote the pension idea?
Oh, I don't know.
Tell you what, folks, I'm going to look it up while Dave talks on the next thing, just because I don't give you bad information.
All right, look it up. But I mean, with the rise of inflation and everything, I think people really do feel like it takes two incomes a lot of time. I know there's a way typically that you can make it work on one income. It's going to involve sacrifices just like anything else. But so does infinite banking requires sacrifices in the beginning. If you want to accumulate capital and create a sizable, meaningful amount there that you can recycle over and over and over for the rest of your life and put towards opportunities and put that money to work, it always requires sacrifices. So, what are you willing to sacrifice? Pain today or pain tomorrow? So, you suffer the pain today. What did Muhammad Ali said, suffer today and be a champion forever.
That's right.
Be a champion for the rest of my life. So you can sacrifice today and live comfortable tomorrow, or you can live comfortable today, but you'll be, working much longer and probably much harder.
Yeah, I think I like the idea of doing the work now so I can live the life that I want to later. Simple as that. So anyway, just to clarify, it was Paul, I can't pronounce his name. It's Paul Louis Perot or Perot, maybe it's French, who wrote the pension idea. And I have a copy of it. But Buffett wrote something else, and I'll bring that up before the end of the episode as well. That was kind of related to pensions.
Okay. Cool. All right, you want to take number 2?
All right, number 2. All right, number 2. If you knew at passive income time that you would be getting back everything that you paid into a system tax-free, would you object to putting more money in it?
Wow.
Well, of course not.
No, no, Paul, I would not.
Right. Right. So, folks, what he's talking about here is, and I've actually been kind of active on some Dave Ramsey videos that one of our friends has pointed out to me, and I'm just in there kind of, as you say, throwing pearls at swine. Like,
Yep.
and there's one guy thinks he's a know-it-all, and of course he is, right? Like, just I'm sure he's got a large 401k balance, and great, that's fine. But I don't think I don't think anyone realizes the reason that our clients and some of our listeners who are not our clients, but they're clients of somebody else, and Dave and I personally, why we pay high premium relative to our income is so that we are creating another guaranteed income stream in retirement, right? A guaranteed passive income stream. And Nelson talks about this in the book. He doesn't call it retirement. He calls it passive income time. Mm-hmm. But I don't think people realize that you can use a whole life policy and I would say, what's the right word maybe? You can annuitize it in a way in passive income time to take money out or against the policy so that you could supplement maybe some other retirement accounts that you've built or a pension or something else. Maybe you have an annuity or something, whatever it is. But you can use it also as a hedge against sequence of returns risk. When the market is down, you don't want to take from those accounts that are in the market. You can take from here instead. And that way you don't compound your loss.
Yeah. Tax free.
Without tax.
Nelson says, you'll be getting back everything you paid into it. Really, if you're doing this for any amount of time, you're going to get back more than what you paid into it. Tax free.
Right. And
not just what you put into it.
The longer you're doing this, the better it is. And Nelson talks about in the book as well. Imagine, something that gets better with age, no matter what. Mm-hmm. Right? Very few things do that in life, right?
Yeah.
Like, I think your ears keep growing; they keep getting larger as you age. But
ears and nose, we were
great.
I don't even know if wine gets better with age.
No.
For a certain point, like when we were in the Bahamas last year, we saw the oldest bottle of wine in the world.
Right.
And I forget how
you can't drink that.
You can't drink that.
You can't drink it. They say French wine you can drink. It can last a long time, but like California, Oregon, and other wines from the world are more shorter duration. I think 10 to 20 rather than 20 to 30 years. I'm not a wine connoisseur. I just drink it and I don't even know if I really like it, but I drink it anyway.
Yeah. All right. So that's good. Really what Nelson's talking about here is don't be afraid to capitalize. That's one of his principles. Don't be afraid to capitalize. Correct. And if you know that you're going to get back everything you ever put into that system and more tax-free, why would you want to put less into that system? Don't be afraid to capitalize. Do more. And higher premiums equal more wealth, equal more income in those passive income years to pull out tax-free. So it's all related.
Correcto. I'm sorry, I'm still looking for this thing. People probably like, whoops, what is Paul
Buffett
doing?
Book.
I've got a copy of it, and it's annoying me, but I got it. Here it is. It's in my files. So I want to point people to this. You can find it open source, but it's called. The title of my file is Warren Buffett, Catherine Graham Letter, and for some reason I can't open
the pension idea is on page 91 of Nelson's book. That's the first
one
he mentions in the stock market section of suggested reading.
Correct. Yeah. And I have a copy of that. I'm just looking at my desktop, and I have that. I have iPencil. If you haven't read that, that's a great little.
That's great. Yeah. Yep. Even the Tuttle Twins version of that.
Yeah, the Magnificent Pencil or whatever.
Yeah. Yeah. Yeah, that's great. So okay, well let's move on. Number three.
Go ahead.
Number 3. Page 85. When you get paid for work, you put all of it into someone else's bank and then write checks from that account to buy the things of life. So someone else's bank gets all of your money. If you owned a banking system, would you want to run all of your business through your bank? If this is so, then life insurance premiums paid each year should ultimately equal annual income. This can't be done immediately. It will take the average person about 20 years to reach this level. If this message is taught to succeeding generations, then a perpetual banking system can be achieved. Wow. What do you think of that?
Yeah. Page 48, expanding the system to accommodate all income, talks in a little bit more detail about how premiums and incomes should match. And of course, well, Paul, you told me that the life insurance company won't let me pay more than, let's say, 15% of my income.
Up to
So I
30.
like to have,
Yep.
right. And we can argue for more in certain cases, depending on what your income is. But the higher your income, the higher percentage of premium you could pay relative to your income, just
Right.
in case anyone's wondering. Big difference between someone who makes $1 million and someone who makes 50 grand. So,
Right.
the one thing people have trouble understanding, and I think I felt like this early on too, is that you have to remember, as time goes on, the dividends, the non-guaranteed but very reliable dividends that these policies receive as a return of excess premium, you're not taxed, make the policy bigger, they become quite large. They become as large and larger than the premium itself. So by year 20, the dividend is big enough to pay the entire premium, let's say.
Wait a minute,
Right?
Paul. Dave Ramsey tells me that
Yeah, I
the
know.
IRS classifies dividends as a return of premium.
Overcharge premium
The
or
premium
whatever.
that you overpaid on that. That's all you're getting back. So how in the world can you get back more than what you paid?
Yeah. Well, he's just, I mean, technically, it is correct. It's a
By
non-taxable,
definition, yes.
yep, it's a non-taxable event, especially when you're using it to buy paid up additions. People like to say it's getting reinvested into the policy. I suppose that's a way to look at it, but that's not the right vocabulary.
Right.
But the dividends become quite large. So it is possible, if you are paying significant premium, I suppose, in a way that your premiums and income, if your income became, was static, you just made 100K and you started this early enough that, yes, in theory, the premiums could match your income at some point, because a dividend, you should look at, it literally is premium,
premium.
going to you.
Yeah, but
Right?
it doesn't count against you.
Correct.
Right.
It doesn't.
That's
That's
premium.
right.
Yep. Yeah, good point. This often is pretty difficult to conceptualize and in reality make happen, because really over 20 years your income is going to increase too.
Sure.
I mean, how much has your income increased over the last 20 years?
Yeah, a lot. I mean, I remember as a second lieutenant making $1,200 every 2 weeks.
Right. So your income, yeah, multiple times more than that over 20 years.
Sure.
So, but
Just
yeah,
to inflation,
make
it's going to go up.
right, and you make a good point that that those dividends, yeah, that's premium. So that counts towards how much income you're putting towards premium. How cool is that?
It's premium that you don't have to come out of pocket for.
Yeah. Yep.
And that's
so really
beautiful.
And then when Nelson talks that last sentence about teaching this to succeeding generations, that's where it goes back to his principle of think long range. This is not just about the next 10 years. It's not just about your lifetime. It's long range. It's generational.
Yep. And Nelson explains that in the book. He actually talks a lot about grandparents owning policies on their grandchildren, but a lot of our parents are our age or younger in some cases. Like you should own policies on your adolescent children. And if you don't, you need to do that right now. They don't have to be big at all.
No, they're usually not.
And they're usually not. You don't want to use up all their insurability, right? But get them going. And if you watched our episode with Lieutenant Colonel retired Scott McKay, he talks about the policy, and he's got his sons. They just went through underwriting again for their second policies, right? And how much wealth they're going to have by the time they're our age that they can get to, that they can access, all in a tax-free environment.
Yeah.
Phenomenal.
How cool. Yep. And then, to hit on another principle of Nelson's, don't do business with banks. Why would you put money in somebody else's bank when you can put it in your own? But the only way to not do business with banks is to have your own banking system.
Yep. And it's going to take you 20 to 25 years, folks, to wean yourself off of the banks. I'm still weaning myself off the banks. Dave is still weaning himself off the banks. It is a lifelong process, really. Continual process.
Yeah. But how much quicker will it be for my kids to wean themselves off the banks? Because
Far
of the head start
quicker.
they have.
That's right.
Yeah. So pretty amazing.
Yeah, they're not having to build the system.
Yeah.
The system has already been built for them.
Yep. They
That's
just
the
have to
fundamental
continue
difference.
the system.
They just have to expand
Perpetuate
the
it.
system. That's right.
Expand it. Yeah.
Hey guys, next week, tune in for part 2 of our page 85 review.
Until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.